Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Enlightened investors, happy to be back with you today. I'm your host, Dr. Allen. We have a value bomb of information for you today as we discover with our guest how to snowball into a large net worth and a passive income from small personal funds. Are you perhaps a busy professional, passionate about the work of your calling, but you have come to realize that the hope of developing financial independence has taken a back seat to priorities of following your passion? If you can identify, I have good news. Steve Tucker Capital is an investment company designed for passionate, fulfilled professionals like you to help you develop financial independence built on solid passive real estate investments. Go to our website and enroll in Enlightened Investor Circle. There you'll receive education and support for your passive real estate investing goals, no matter your level of experience and expertise. Our guest, Scott Price, is a full-time real estate investor and coach who has snowballed initial small personal funds into an expanding portfolio of cash-flowing multifamily, office, and retail properties on his own without needing to take on partners. Scott, before we get into the business of snowballing our investments into a large net worth, share with us an experience from your formative years that helped you to be the person you are today.
Sure. Yeah, thanks for having me on, Alan. I would say that a particularly formative experience or series of experiences were around family trips that we took as a kid and when I was at home. And the reason that they were so formative, including going all the way to adulthood and even affecting my decisions to get into real estate investing, is that the beauty that's out in the world and the variety of things that are out there and some of the places we would go. I lived on the East Coast, but we would, go all the way across to Grand Canyon and Yellowstone and all these kinds of places, and really opened my eyes and mind to what is out there to experience in the world. And as I got to be older, I realized I wanted to do more of that. And I wanted to plan my life more around positive, interesting, impactful experiences. And that really, in many ways, was then a follow through on, okay, how do I do that? And I moved to where I wanted to go because of those kinds of experiences. And I set up a lifestyle where I had more time flexibility and an ability to take trips and do little outdoor adventures and travel and things like that. And so it's interesting how those little experiences going way back can actually percolate through my entire life in some ways that even come through in terms of business and career decisions and where I live and things like that.
Yeah, a lot of times as adults, we like to negate those early experiences, but really and truly, they are formative and they do make a difference throughout our entire lives. Scott, you have been successful as a real estate investor, and you built that up on specific strategies. So share with us some of the strategies that you have built your success upon.
Sure. Yeah, a lot of it has so far been on the idea of always thinking ahead to how I can leverage my existing funds to create more income, more net worth over time. That seems obvious, but at the same time, if you just buy a property and then get it all set up and then say, okay, now I need to start on thinking about how I'm going to do my next property, then you're actually a little bit behind the eight ball. You should have started thinking about that before you bought the prior property. And there are a number of methods to do that. In my case, I essentially started out just with my own, all of my own funds. And it wasn't like I did zero down and all these kinds of things that some people talk about. I did work at a decent job and save some money to get started, and not a huge amount, but just enough to get a down payment going. But I always thought about, okay, what can I do on this property to roll forward into the next property to go from 1 to 2 to 4 to 8 to 16 to 32, et cetera. And that's been very fundamental to me. For instance, right now, as we speak, I'm selling a property and I'm very focused on working with a lender that can provide an 80% loan to value, so I can maximize my funds to buy multiple other properties with the proceeds from this first property. And then I'm also looking at the income stream from these new properties to make sure that I'm expanding it, not taking a step back. And already figuring that out, I wouldn't have sold the property if I couldn't have replaced it with more in terms of both income and net worth. So it's been along the way, it's been very fundamental because I worked a W-2 job for many years and did real estate investing on the side, but it was always with the intention of gradually building. And when I say that I've done it on my own, the advantage of that is, of course, it's very nimble, and also you don't have the awesome responsibility of managing other people's money. But at the same time, that doesn't mean I don't want to do that. I actually will be doing that in the future. And now that I'm very full time and have a good portfolio, I will be getting into syndications here shortly. But that's just in an effort to build the business even beyond my own funds.
Yeah, all of us have to come to that realization if we want to grow the business. We are going to, at some point in time, have to rely on other people's money. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
I don't know how long ago this was when you got started, but if you could take us back to that first real estate investment, you said from the very beginning you were always thinking about the next step and the next step. Take us back to that beginning and that first investment, and how it is that with that first investment, you were able to look beyond that investment onto the next one and the next one.
Sure. Yeah. I'll actually, if you don't mind, start with my second investment. And the reason is my very first investment, I would say, is paying the tuition of experience, but it actually did not put me on the right path. And what I mean by that is my very first investment was just a single unit rental that I kept and did not have a good experience with tenants and sold, and actually thought, oh, this real estate thing sucks. And then I realized the mistakes that I had made, including not having a professional property manager to act as a buffer for me in dealing with the bad tenants, and among a couple other things, chalk that up to experience and eventually realized, okay, this is how I need to systematize this and have a larger team to help me with it. And then I started thinking bigger. So when I got to my second investment, which is really the kind of the crux of your question of how I started snowballing, I That one actually was essentially a development deal on my personal residence. And I intentionally did a very complex process where I added significant value by working with neighbors and doing easements and a number of fairly complex things, where I was able to double the value of my personal residence. And in terms of the marketability of the property and how it could be used. And I had a couple ideas there in terms of, or I should say plans there in terms of why I was doing that. Initially, it was to increase the value, but then also so that I could then roll that equity forward. And in my case, I could have, in anybody's case, if they quickly double the value of their property, of their personal residence and sell it, some people might go woohoo and buy a nicer, fancier home. And in my case, I actually took a step back in home, not as desirable of a neighborhood, not as desirable of a home. And that was very intentional. In other words, I went from a nicer home to, it was still fine. It wasn't a slum or anything, but it was a bit of a step back. But I used the rest of the equity to buy a 29 unit apartment complex. And I jumped right in. I had the 1 unit before and then boom, just jumped right in. And then on that, the idea was, okay, now I actually have something that has a decent amount of income and on a monthly basis. And I was able to, and I knew that I would be able to actually save that money because I had a W-2 job. So the rental income was not something that I relied upon for paying the bills. And so my plan there was then to roll that into something else. The next thing I rolled it into was not larger than 29, but nonetheless, it was another property. And then what I started doing was essentially snowballing between different methods of using either my own cash or the income from the properties that I was slowly accumulating, or in some cases doing cash out refinances. In other words, still buy and holding, but using the increased equity and taking it back out, having a slightly higher mortgage payment, but now being able to buy another property, ride the inflation train on that property, and rinse and repeat. And by doing that, then over time, I was able to purchase more multifamily properties, as well as get into some small office and retail properties. I did some other things too, land and single family homes and things like that. I still have those as well. And yeah, but it was all, again, very intentional. I even did things like take a loan that you can do where you can take a loan up to $50,000 from your 401k. And so I would do that. And actually in one case, I had a property that could make me enough money that I took money out of my 401k and paid the penalty. And because the money I made on the other side was so much more, and I trusted myself that I wasn't buying a depreciating asset. I wasn't buying a fancy car or a boat or something like that with the money. I was actually investing it and reinvesting it. So it didn't bother me that I was taking it out of my 401k. I was just moving it into actually a more controllable investment. So yeah, so as far as how I started, to answer your question, that was it. And I just started rolling that philosophy forward.
Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom. As you explained, it was your second property, but it was your own personal property. You were telling us that you created value in the property by working with neighbors, changing the easements. Could you give us some specifics about what you were doing there? Because it's a little astounding to me that you could actually double the value of your property just by changing easements. So take us through some details on that project.
Sure. Yeah, it was a unique opportunity that basically I realized after purchasing the property. Again, this is my residence. I'm not saying that I bought the property for this reason. After I purchased it, I realized, oh, there's opportunity here. And this is the way for me to jump into something bigger, like I said, the 29 unit, instead of my original intention of jumping into a duplex or a fourplex first, or something like that. And it's still applying the same philosophy, but this allowed me to accelerate things a lot quicker. And essentially, the short version of a far longer story is that I bought essentially a waterfront shack, and a beautiful location, but old building, and it had walk down access. And what that means is you cannot drive a car up to it. You had to walk about at least 200 feet from your car to the house, between other people's property. And because of that, I got it very inexpensive, because most people want to be able to drive up to their car, and you know, bring in your groceries in the rain down a slight hill. It didn't appeal to a lot of people, but I had a gorgeous waterfront location. And I actually I owned a 4-foot trail. Literally, it wasn't an easement. I owned a 4-foot section that went from the road down to my property. My neighbors also owned a 4-foot, 2 of them. And we got together and realized that between the 3 of us, we could swap mutual easements on our side-by-side 4 feet and have 12 feet. And we could create a driveway down to our waterfront homes. All 3 of us had walk down access. And very arduous process, especially anytime you get near the water. There's always extra requirements and permitting process and things like that. However, after a couple years of going through that, we now changed our walk down waterfront home into a drive up waterfront home. And that made a huge difference. Even though I still had an old waterfront shack, it now was a drive up waterfront shack. And actually, when I sold it, the person that bought it, they were actually intending to buy it just for essentially the land value. They were going to replace the home that was there with something brand new.
I can see how giving access to a property could increase its value substantially. That was certainly smart thinking and strategizing. You walked us through and showed us how you can snowball from one. Your first multifamily was the 28-unit building. Did you refinance that to get to your second property, or was it from the income from that property?
That one was initially to get to my next property. I did refinance that property later, actually twice. I've refinanced that property, but not immediately. So as far as to your question, I used income from that property. And then frankly, I was living fairly frugally too. I was, like I said, took a step down in terms of home, and we're not big spenders, and we don't have fancy cars and all that kind of stuff. And so I also saved some money from my job as well. So the combination of the two, and I think this has been a number of years because I've been doing this for 16 years, but I believe that I expect that I probably also took a loan from my 401k that I mentioned too, that 50K 401k. So between the 3, saving from my job and income from the property and a loan from my 401k, that would likely be how I made the next jump. Just thinking about just me knowing me. That's probably what I did back then. That's been, like I said, 15 years ago. So
yeah, you have combined a number of different strategies from personal savings, cash flowing properties, and then retirement funds. And 3 very different strategies, put them all together, and we're able to expand into a second property. Your third, your fourth, up to your 8th properties, I expect you've been employing those same strategies throughout the course of the last several years. We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. You started out with multifamily and you moved into office and into retail. Those are very different segments. What are the differences and what should investors be looking for if they're looking at various different segments of the real estate industry?
Yeah, they are very different, and it is very important to go into office and retail with eyes wide open on those key differences. They can be a very interesting asset class to work in. I'm very selective on those, and as everybody knows, it's been somewhat accelerated by COVID-19 in terms of work from home, even though people are going to be going back to the office, but nonetheless, there's been a gradual shift over time to at least more work from home opportunities, more telework opportunities, and also on retail. Of course, it now post COVID is making a bounce back, but nonetheless, at the same time, there's still a lot of pressures on retail, and there's in terms of not just e-commerce, but also where people are going, what kind of stores they're visiting, and which ones they're not, how people are experiencing retail and how they want to experience it, what they need to be around it, all those kinds of things. And it's my general preference is multifamily, like frankly many investors, which makes it very competitive. But multifamily I generally prefer because of a lot of essentials, including the fact that no matter what's going on with office and retail, people need a place to live. It boils down to, a lot of times it boils down to that. And the other thing is that with multifamily, it is easier to adjust some fairly simple things to be competitive and take care of vacancy. And by that, you don't want to, but if you have vacancies and you have to get something filled, generally speaking, if you've got at least a solid market with good employment and population steady or increasing and things like that, and not too much new construction in the pipeline, generally speaking, if you throw in a concession or reduce the price a little bit, you can generally get it filled. It's a generalization, but it's generally true. And whereas when you get into office and retail, there's a lot more than that. You for office, for instance, well, actually for both office and retail, you need to be thinking, even if you buy a property that is currently occupied with perhaps even a good tenant. And with office and retail, you can frequently get 5-year leases or more. So you feel, okay, this is nice, not the normal 1 year with multifamily, and that is nice as long as it goes and as long as the business stays in business and things like that, the tenant business. But the thing you always need to be thinking about is who would specifically fill that location next. And that's very different than multifamily. Multifamily is a little bit more homogeneous. Again, yeah, one place has granite countertops and one doesn't, but usually you can just adjust things on price and you can find your customer, meaning your tenant. Whereas if you have an office or retail space, you have a certain amount of square footage, a certain amount of parking, a certain amount of visibility, a certain amount of or certain mix of what's immediately around it. And all of that factors into who would even want to be there as a business or for office or as a business for retail. And you may have a great property, but it could sit there vacant for a year or more because you've got to find the exact right mix of desirability for your office or retail. And you got to be prepared for that in office and retail. So I think that from what I've seen, some people get in trouble with office and retail where they're not actively thinking about the next tenant. They're only thinking about the current one. People will buy even a Dollar General store or something, which can actually, in many cases, be a good investment. But there are vacant Dollar General stores, as an example, and people think, oh, it's a Dollar General store, they'll be there forever. Not necessarily. Walgreens will not necessarily be there forever. And if you buy a Walgreens, and there are vacant Walgreens out there that somebody bought with a 5-year lease and then Walgreens decided to close up shop and go somewhere else. Wow, you have a very specialized property, very expensive, that now you've got to fill and it's vacant. And that's a big difference than an apartment. So it's a little riskier in some cases, but it can also be a lot of benefits to it. Generally speaking, you can get much longer leases. Like I said, I've got one right now that's a 10-year lease, for instance. And so that's a big benefit. You don't have the churn. Also, frequently the business will take, if you have a triple net property, which is a property where the tenant actually pays for all of the expenses, landscaping, repairs, things like that. That can be great. Obviously, you don't get that with multifamily. And also, frankly, most businesses have a vested interest to keep the property up, whereas you don't always get that with residential renters. It sometimes seems like it's the opposite. It's amazing what some people will live in, their own self-created conditions, whereas a business, they want to look good to the world, so they want to keep the property up. And that's another benefit of office and retail. So they have their pluses and minuses, no doubt about it. And that's why I'm in both. I'm very selective on both. And office and retail in particular, when I apply that thinking of what's the next tenant, I always buy it with a current good, strong tenant, but I don't go on the assumption that that tenant will be there forever. I hope they will, but I don't go on that assumption coming in.
How have you fared with your office and retail through the pandemic?
Actually, which is good, partly because some of my office and retail are actually medical office, and they've actually done well, or at least continued to do pretty well. There was a little bit of blip and a little bit of a concern among the tenants on just like everybody in the March to April, May timeframe of 2020, when things were getting rolling with COVID and new regulations were coming out and policies and restrictions and things like that. But after things evened out, their business was essentially steady for the most part. For some of the others who are not medical office, fortunately, I've gone with just good, strong tenants. I've always focused on that, not just the business, not just the location, but also the business itself. And most of the tenants have been there long term. I make it reasonable. I make a profit. They're getting a maybe market rate or maybe a little below that, but close to it. And I take really good care of the properties and take good care of them, and they're incentivized to stay, and then it's good for everyone.
Yeah. You managed to do your real estate business without the complexities of syndication, which not very many people are able to do, at least not able to scale to the same degree that you have been able to do. What have you learned, and how have you learned to bounce back from setbacks?
Yeah, a lot of it has to, I'd say a couple different things. One of it has to do with mindset. And what I mean by that is making sure that I always have the bigger picture in mind. That was one of the reasons that true first investment, which again was just a single unit, that one did not go well because I had a bad tenant experience, and I kind of lost at that time I lost the bigger picture, and I wasn't thinking in terms of, okay, how can I address this through a team, and how can I address this through better tenant selection, and also to treat it more as an arm's length business, as opposed to taking, in that case, the lies and the bad actions of a particular bad tenant and not taking that personally, which I did. They dealt with me in a way that I would never deal with anyone. And it was shocking to me that people could do that. And now I understand that some people are like that, and it's part of the business, and don't take it personally and lose sleep over it, which I did in that first case. And so that was one thing in terms of mindset and setbacks. Another thing, frankly, is if it's a financial setback, such as, say, a large capital expense that may come up that might have been unexpected, and I've had that happen several times. So in that case, it is generally boiled down to just making sure that it's something fairly simple, but making sure I have some reserves and I have something to actually draw upon. And I've always done that. I've always made sure that I have a buffer work with, not just living on the razor's edge of 100% deployed and no backup funds and things like that. And that makes it easier. It also enables me to jump on good deals because I keep some funds liquid that are both for reserves as well as for available for down payments on new properties. Like right now, the property that I am in process of selling and looking for replacements for, I have another property. I'm in process of selling one. I have another property under contract that would be a 1031 exchange replacement. But if for some reason my initial property, my relinquished property if that deal doesn't go through, I still have the reserves that I can take down or purchase the second property so I can move forward. And then as far as another aspect of bouncing back from setbacks is keeping them in the context of a larger plan. And so, for instance, if there's a unit down at a particular apartment complex, I'm always keeping in mind that's just one of many units. It's a part of a larger plan. It's just, it all evens out. It's another unit will be down another day. And once you get enough volume going, then taking some of those smaller setbacks just evens out it's a little extreme to say in the rounding error. It's not quite that, but at the same time, it evens out as just part of the expense of doing business as a real estate investor.
Well, a lot of good perspectives that you have shared with us today, and all of them based on having a strategy, sticking to your strategy, and having the confidence and the faith to stay with the plan that you have laid out. So something to be said for going steady at the pace that is comfortable for you. It has worked well for you. A good example for all of us, really, no matter where we are on our investment journey. Scott, before we go into our last segment here, share with our viewers and listeners how they can get in touch with you.
Sure. The easiest way is to go to my website, which is bonvolo.com. That's B-O-N as in November, V as in Victor, OLO.com. And on there, you can reach me by email, by phone, learn a little bit about what we're doing. We're actually now getting into the phase of, now that COVID is going away, I've deliberately been holding off until things settled out, but we're now starting to get into the phase of working with other investors, because even the properties I'm buying now, I'm buying on my own, but we will be in the future. And then the other aspect is I have been for several years providing coaching services as well. It's just hourly based, so it's not some guru program you pay some ridiculous amount of money and all that kind of stuff. It can be 1 hour, it can be whatever you want. Very flexible. And that's all on the website as well.
You certainly do have some good advice and good coaching skills there to offer. So viewers and listeners, pay Scott a visit there, and his contact information will be in the show notes. Scott, share with us one of your most difficult setbacks in life, and how did you come through that time, and what did you learn from that experience?
Oh, let's see here. Let's see. I have to think about that one. I would say that perhaps, especially in the real estate context, I've dealt with different ones, but I would say in real estate context, when I was starting out early on, I had a property that experienced an unexpectedly significant issue with the roofs, and the property was large enough that the total cost to repair everything that occurred was about $100,000. And this is early in my investing, where I'm trying to balance things, and yeah, I had some buffer and stuff, but that was, it still is a significant amount, but it was a very significant amount at that point. And so it was a big eye-opener to the scale that you can go in all directions with real estate, and that you've got to be prepared for. And my property, so mine and the banks, I always say that because of course I had a loan on it, my property, and I'm responsible for it. So in that case, I just again implemented some of the same approaches. I believe in that case, I think I may have even gotten a HELOC. Again, that was about 13, 14 years ago, something like that. But just again, using what opportunities I had to leverage money without the need to use OPM, other people's money. And I got through it. And afterwards. That property has been, it's been a good cash flower ever since. But it was a significant gulp kind of moment, especially as a beginner investor of, oh my gosh. And when you have an expense like that, and those are the things that some people don't think about. They say, oh my gosh, my property cash flows, whatever. They got a small property and it cash flows $1,000 a month or something like that. And they're all happy about it. But there are a lot of investors who don't factor in capital expenses. And if you have a property that is cash flowing, whatever, a few $1,000s a month, and then you get a $100,000 bill, then that means you've literally obliterated years of the equivalent of years of income. And so that's why it's really important to go in with good inspections and have a capital expense plan, and also to have some reserves.
Yeah, not only wiping out income, but also wiping out equity. And those things happen. And we need to go into real estate with eyes wide open. It's difficult.
Oh, yeah. I do far better inspections now, that's for sure. I do very in-depth inspections now.
It's amazing what we can learn from those setbacks. They're our greatest teachers, though not the most pleasant experiences in life. How are you putting your success as an investor and entrepreneur to work to create universal well-being and abundance for all beings?
Several things. I do work with several nonprofits. I'm on the board of several organizations in the community. One of them is oriented to our local community. Another one is oriented to the arts community. I've recently been involved. Just because of time reasons, I got off that board, but I was most recently also involved in an environmental group, a number of things. My definitely by far my biggest, hopefully people look at it as a contribution, I believe they do from the reception it's gotten, is this past year. In this past year, I personally created and opened and funded and managed and created a nonprofit and the whole deal, a community sculpture park. And it's both a nature preserve where the entire forest habitat is permanently protected through a conservation easement now on the land that I purchased and own. And then it also, within the forest trails, is very interesting, unique art, that outdoor art sculpture that people get to enjoy. And it's just been open since fall of 2020, and it's been terrific. The community seems to really love it, and it's free. I want to make it so that anybody can come, and a lot of families come. It exposes a lot of people both to nature and art, which was the original intention, and being free to everyone has really increased the number of people come and experience it.
Wow, what an interesting thing to do. Are the sculpting local artists, or how?
They are, and national. And actually, we're about to get our first international sculptor from Amsterdam, but they're actually from throughout the country.
Great. What a wonderful thing to do. And I am sure the community will appreciate that for many years to come. Well, imagine that you have come to the end of your life, and as you lay on your deathbed, what do you look back on your life with your greatest sense of joy, satisfaction, and fulfillment?
I would say that I have actively pursued and do not have a regret about, which is very important already, not even thinking way further ahead in terms of a deathbed perspective, but I have been very active and have actively pursued a lifestyle that in many cases really tries to enjoy what there is in life, but not from the perspective of just going out and doing random things and taking. In other words, there's got to be a balance. You can be just gonzo going out and try to check off as many countries as you can and travel and all that kind of stuff. But you also need to balance that with time for family and time for community and providing things that can provide a positive legacy after you're gone and things like that. And I already feel good about the balance that I've created between those things. In other words, doing a lot of really what I consider to be interesting and fun things in life and unique things in life, with also balancing those other things that are fundamental, again, family and community and legacy and things like that. I'm happy on the path I'm going. I still have more to do, as everybody, more that I'd like to do in all those areas, but I feel good about it, where I've been and where I'm going.
Scott, thank you for sharing your investing wisdom and expertise, and also thank you for sharing your life with us today. It's been a pleasure having you today.
Thank you. I appreciate it, Alan. It was a great conversation.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.